What's up, everybody? It's Joshua, and I hope you're doing fantastic. Hey, listen, I got a great video for you today. We're talking dividend stocks, everybody's favorite type of stock, but not just any dividend-paying stock. I went and I found 6 of the highest-paying dividend stocks on the market right now that you can start investing in today to earn income, passive income, as soon as next month. So I've got my notes here. I've got my coffee, which I'm gonna go ahead and take a sip of right now. Ooh, that's delicious. And without wasting any more of your time, let's go ahead and get started. All right, so the first dividend stock on this list is gonna be NLY, also known as Annaly Capital Management Inc. And it has a juicy dividend yield of, wait for it, 9.62%. That's a really high dividend yield. The 9.62 dividend yield that this stock offers will earn you about $962 every year on 1,000 shares. So NLY is a mortgage real estate investment trust. That's right, this is technically a REIT and not a stock. However, as you probably already know, REITs do trade on the stock market exactly like stocks. Buying shares of a REIT is literally the exact same thing as buying shares of a stock on the stock market, and that's why we sort of just categorize them together. Although they are technically different investment vehicles, they do trade the exact same way. So NLY generates income or profit by investing in mortgage-backed securities and then collecting coupon payments from those securities. A mortgage-backed security is a type of bond that invests in real estate loans, which are bought from the banks that issued them. You see, when a bank gives you a mortgage for like a new home or for your business, they aren't actually keeping that mortgage in their book. Instead, they simply just sell your mortgage to an investment bank where it's then added to a bundle of other mortgages. It could be hundreds of different mortgages or thousands of mortgages, but they bundle it together and then they sell that as a bond to investors who then earn interest on the mortgages. Now, like with all of the stocks on this list, there are obvious pros and cons to holding this specific stock or this REIT in your portfolio. The one obvious pro is that the dividend yield is extremely high on this REIT. So depending on how many shares of the REIT you actually purchase, you could end up either paying bills with the dividends that you receive or just living off them completely. Now, the one big downside to owning any of these like really high dividend paying stocks is that they don't really have much long-term growth potential. For example, investing in a stock such as Apple or Walmart or some other blue chip stock will pretty much guarantee that your portfolio will grow over the long term. However, the dividends that those types of stocks pay are also significantly lower than the dividends that these stocks on this list are paying. So when it comes to dividends versus like the appreciation of the stock, the growth of it, you're kind of giving up one for the other. So if you want to invest in a stock that has super high dividend payments, more often than not, that same stock is not also going to have very high growth potential. But if you're looking for like pure income from dividends, then investing in a stock like NLY, which has a very high dividend payment but not much growth, would make a lot of sense for you. All right, next up at number 2, we've got AGNC, also known as AGNC Investment Corp. This stock currently has a scrumptious dividend yield of 8.49%. This means that by investing in this stock, you'll earn about $849 every year on 1,000 shares invested. Now, I know what you might be thinking right now. Okay, Joshua, if the dividend yield on this stock is lower than the dividend yield on the last stock that we talked about, NLY, why would I not just put all my money into the last stock if the dividend yield's higher? Wouldn't that make more sense? Well, honestly, that's a really good question, and I love the way you're thinking, but the answer is very simple: diversification. All of these high dividend stocks on this list are very risky investments, and so you wouldn't want to go and put all your eggs into one basket. I mean, frankly, you wouldn't want to put all your eggs in one basket even with a blue chip stock. You wouldn't want to go invest your entire portfolio in Amazon, because what if Amazon tanks and then your entire portfolio tanks because you're not diversified? So the same thing is especially true with these really high risk, high dividend paying stocks, in that you should not put all your eggs in one basket. You want to diversify as much as possible when it comes to these stocks. So like with the first stock on this list, AGNC is also a REIT, and it invests primarily in residential mortgage-backed securities. The difference though is that AGNC specifically buys government-backed mortgages, also known as agency mortgages. So this means that this investment is technically a little bit safer because the government actually backs both the interest and the principal payments of the mortgages that this stock holds. Okay, so coming in high at number 3, we've got PSEC, also known as Prospect Capital. This stock currently has a dividend yield of about 8.25%, which means that every year you'll earn about $825 on 1,000 shares invested. So PSEC was founded back in 2004, and believe it or not, this one is not a REIT. Instead, it's a company that provides both private debt and equity to middle market companies within the United States. It makes money by collecting interest payments on all the various loans and different debts that it gives out to all these different companies. And just for some clarification here, middle market companies in America are technically companies that have revenues between between 10 million and $1 billion. So middle market companies can be really good investments because they provide potentially a high level of growth that you can't see like in a Fortune 1000 level company, but they're also not as risky as a small business, right? Because they're more established than a small business. This means that all the loans that PSCC is giving out to these middle market companies aren't really at risk of being defaulted on because the company is established. So it's not as risky as giving a loan to, say, a small business, which has a lot more potential to fail than a business that's already established its market. All right, so the fourth stock on this list is DX, or Dynex Capital, and this stock currently has a dividend yield of about 8.03% at the time of this recording. This means that with 1,000 shares of this stock, whatever, you get the point. Now, like with the majority of the stocks on this list, DX is also a REIT that invests in mortgage-backed securities, and it makes money on the interest that it collects from those mortgages, which is then paid out as dividends to investors. So DX invests in both agency and non-agency mortgages. Agency mortgages are created by one of the three main government agencies: Freddie Mac, Fannie Mae, and Ginnie Mae. So if it wasn't already obvious enough, investing in agency mortgages tends to be a lot safer because the mortgage is actually backed by the US government, whereas a non-agency mortgage is not backed by the US government. So if you're looking for another dividend stock to elevate your dividend portfolio, then this one's definitely worth considering. With an 8% dividend yield, there's no doubt that this one's going to give you that sweet passive dividend income that you're looking for. Next up on the list is NRZ, or New Residential Investment Corp, and this stock has a dividend yield of 7.58%, which means, okay. So as the name probably implies, NRZ is a REIT, and it invests primarily in mortgages, mortgage-backed securities, and other types of financial instruments pertaining to real estate. Now, by this point in the video, you probably see a trend and you're wondering to yourself, why are there so many REITs on this list? Well, it just so happens that REITs tend to have pretty high dividend payouts because of the way that they're set up. You see, interestingly enough, REITs are actually required by law to pay out a minimum 90% of their profit as dividends to investors. But this also explains why so many REITs have such a hard time growing in value. With 90% of its profits being paid to investors, that only leaves about 10% left to reinvest back into the company. But if you're an investor who's looking for income in the form of dividends, then investing in REITs is definitely the way to go because they tend to have much higher dividend yields. All right, so last up on the list is HRZN, or Horizon Technology Finance Corp. This stock has a dividend yield of 6.84%, which means with 1,000 shares, you can earn about $684 every year. So believe it or not, this stock is actually not a REIT. HRZN is a venture lending platform that provides structured debt products to life science and technology companies. So HRZN has collectively invested over $5 billion worth of venture loans to thousands of different companies, and they make their money through capital appreciation and the interest on the venture loans that they provide, which they then in turn pay to investors in the form of dividends. Now, HRZN is not a REIT, and so they're not paying 90% of their profits to investors in the form of dividends, but they're still paying a significant percentage of their profits. We know this because the dividend yield is so high. Now, don't get me wrong, I get it. There's gonna be somebody, one person, who leaves a comment on this video and says, Joshua, you're clueless. Don't you know that high dividend paying stocks like this don't add any growth potential for your portfolio? Stop making videos right now. Okay, yes, I understand that perspective, but if I haven't already alluded to it earlier in the video, let me just briefly break down something that I think everybody watching right now can take away from. Everybody has different investing goals. Now, most people are probably going to be investing for retirement, and so of course, naturally, they'll be investing in assets that will grow their portfolio, such as like an S&P 500 ETF, or a good blue chip stock or growth stock, something that is going to build their portfolio over the long term and give them that compound interest. However, there are also people who want to solely invest to earn income in the form of dividends. So for those individuals, the stocks that we talked about in this video are perfect. Now, I do want to mention that I tried really hard to pick stocks to add to this list that weren't actually depreciating significantly in value. So although the most common argument is that if you invest in high dividend yielding stocks that it's going to depreciate in value, although that tends to be true, for the stocks on this list, I tried really hard to pick stocks that weren't doing that so that you could still earn that passive income through dividends, but not destroy your portfolio in the process. Now, the last piece of advice that I want to give you that is super important, so listen closely. You need to always do your own research when it comes to investing. No one investor is the exact same. We all have varying degrees of risk tolerance and goals and and just personality profiles that ultimately affect how we choose to invest. So always do what makes the most sense for you and for your life situation, and just block out all the other noise that doesn't align with your investment goals. Hey, do me a huge favor and drop a like down below if you found some value in this video. Also, if you have not already subscribed to my channel but you love finance content like this, definitely subscribe. I would love to have you back on these videos and see your shining face again. As always, I will see you again very soon. Take care.